Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Wednesday, September 7th, 2022, and this is Blockhead Traders Weekly. In this week's episode, I'm joined by fellow Blockhead trader Viper XL 007, and we are going to touch on a little bit more of the option selling strategies that we've been touching on for the past few weeks. We're going to dive a little bit deeper into a potential options earning play that is coming up tomorrow that I myself am going to embark on. However, before we hop to that, I want to give a shout out to our Discord, link in the description below. Hop in there, say hello to myself, Viper, the other Blockhead traders. Love to hear from you. Love to hear what you're trading. Love to hear what type of content you want to hear about. Also, you can find Blockhead Traders wherever you get your podcasts. So if you can't find it on your favorite service, let us know and we will get it there. Viper, let's hop to this week's content. And the first thing that I just want to touch on briefly here this week is I want to keep tabs on the Amazon trade that we have going. So I opened this trade up in the previous episode and it's still going. And I just wanted to kind of visit this trade just to see where it's going and kind of play by play what's actually happening in the world. Let me jump over to the chart that we have pulled up the last time that we visited the Amazon trade. And so what you have right here is that graphic that showed when we opened the Amazon trade, it was a short put. And the thesis on Amazon was that it could go down, but it's not likely to go down dramatically from here. We were relatively bullish on Amazon in general or potentially sideways. But when we played the option, the only direction we didn't want or that our thesis was against was a massive move down. And so the start of this green box is where we opened the Amazon trade on August 29th. And you can see that we pretty much have not gone anywhere on the price action since we opened that trade. And so you might think, hey, Sprocket, that's cute, but you haven't made any money yet. And the interesting thing is, actually, I have. This particular trade is up about 3% as of today for me. And the reason for that is that magical theta Greek that we had talked about when we opened this trade. There are two things that are making us money, and that is the passage of time, because as time passes, the value of that option becomes less. And actually, because we sold here in the 29th and we actually had some red candles, a little bit of up and then some more red candles, the volatility has actually expanded since we sold it. And so if time had not decayed, we actually would probably be a little bit more underwater on this trade. However, the volatility did expand slightly from where we opened it, so that reduced our profit, but the theta has been burning away every single day, and that has able to overpower that volatility expansion to the point of green. And as soon as that volatility comes in a little bit more, that will just speed up and expedite the turning of profit on this particular trade. Because as the volatility goes down and as time passes, both of those things will put more value in my pocket. Just to refresh your memory, if we look back at the potential play here on Amazon, you can see what we put out there was selling the put, as we just shown. We collected the $2.60 or $260 in premium. We had to put up $1,400 in buying power. This was a 20 delta strike, and we had about 18.5% potential upside. So the worst case scenario here was that I was going to end up owning Amazon at a cost basis of $112.40, which was the strike that I sold minus the premium that I collected, that $2.60. So far, this thing is tracking as expected. The theta is burning down. The volatility will start to eat away here soon. So I am happy. I am comfortable in this trade, and we will keep an eye on it as we go. That brings us to this week when I decided to take a look out there about what type of interesting trades could I bring to you guys in this week's episode, and I came across a potential earnings play. I am planning on entering this tomorrow, so by the time this is released, this trade will be over and done with because this trade is going to last a grand total of 1 day. And the reason it's going to last 1 day is because this is an earnings trade, and it will be played earnings for DOCUsign, that is the DOCU company, that is the DOCU ticker, is tomorrow after the bell. And the options that I'm planning on selling actually expire on Friday. So earnings will come out, there will be one trading day, and the options will all vaporize and expire at the end of that trading day. So this is an extremely binary event. This is not the typical methodology that you see of the 75% probability of profit, a slow theta burn in the 35 to 45 days. This is get a trade out there. We're looking for rapid volatility contraction and a move that is going to stay within certain strikes. So one of the things when I talk about volatility, why even consider an earnings trade? Because you might be like, there's so much uncertainty. Why would you even want to consider this? And what I would call your attention to is if you look up the volatility in any earning or any ticker as it approaches earnings, the volatility gets extremely elevated. The reason for that is because there's a lot of uncertainty about what is going to happen when the earnings come out. If you look at the past couple releases of earnings by DOCUsign, you'll find massive gap downs. The price has just been in a big slide. And so as earnings come up, nobody knows what's going to happen. And so remember, options are basically insurance. And so when there's so much uncertainty and there's so much movement that could be there, the insurance premiums are incredibly high. And that is the type of stuff where an option seller loves to see that because they can step in, they can sell that premium at that price as long as it's backed by some theory of price movement behind there that I'm comfortable with. And as soon as that uncertainty is gone, the binary event, that volatility will just evaporate and collapse. And guess what happens when that goes away to the option price? The option price just drops like a rock. And so you can close these things out very, very quickly when earnings plays are out there because that volatility just gets cut in half, gets cut by 70%. Like it just huge contraction of volatility, which leads to big changes in the option price. So the play here is what's actually known as a strangle. Now, this is a little bit different of a play than we had put on for Amazon because a strangle is actually two option legs. You're basically placing you're writing two option contracts. And what you're doing you're doing one to the downside and you're doing one to the upside. So a strangle is two options at different strikes, okay? And what it effectively creates is it says the price will stay between the two strikes that we choose. And you collect a premium on the put on the downside and you collect a premium on the call on the upside. And you sum that premium together to get your potential collection of premium for the trade. And so the thesis here, remember in options, you're going to make money in almost all but one direction. Now, with a strangle, you're actually increasing your risk because you have two directions that you don't want it to go. In a strangle case, you do not want the thing to go to the moon and you do not want the thing to go to zero. In both of those extreme movements, because we've put two options legs on, we basically need to avoid both of those directions. So the thesis here is DOCUsign is not going to go crazy to the upside or crazy to the downside. That is the thesis behind this trade. When I look at strangles, I tend to start my strangles at what's known as a 16 delta strangle. That means I'm looking at the 16 delta put and the 16 delta call. I like to start there because that's typically about a 1 standard deviation move. And I'll look at the premiums to decide, do I want to slide those strikes in closer or do I want to slide them farther apart? In the case of DocuSign, I'm actually pretty comfortable with the 16 delta strikes as is. So what that means is that will be, as of today, a 48 put and a 66 call. So I'm selling a 48 put and I'm selling a 66 call. What that means when we come to expiration is if the price is below $48, I will buy shares at $48 no matter how low the price gets. Okay. I will take assignment at $48 and I will pay $48 per share for DocuSign. The risk to the upside is that I will sell shares of DocuSign at $68 no matter how high it is. So if DocuSign goes to $100 a share, I'm on the hook to sell those shares of DocuSign for $68 to the other option holder contract. So my thesis is we are not going above 68 and we are not going below 66 and 48. And I am collecting $271. This requires about $860 in buying power, so I have a potential of a 25% upside. A key point here is this is a fast trade because it is going to expire the day after I put this trade on. It will be done in 1 day. So that basically means I will return that 25% in 1 day or I won't. So with the Amazon trade, it was very clear what the worst case scenario was. It was, you take assignment of the shares at, whatever that strike price is minus the premium you collected. Same concept applies here, except the problem is you have two worst case scenarios. You have worst case scenario to the downside and you have a worst case scenario to the upside. Worst case scenario to the downside is I buy the shares for $45.29. That is the strike price of 48 minus the $2.71 premium that I'm going to collect. So that would be my cost basis to the downside. My risk to the upside is kind of the opposite, where I will be short 100 shares at $68.71. And I don't think shorting stock is something that we've talked about a lot in the episode. It's basically betting the stock will go down. So when you short a stock, you basically borrow stock that you don't have from your broker and you sell it to somebody else. And then you're betting that that stock is going to go down from the point where you sell it so that you can buy it back from the market to what's known as cover your short, or basically close out your position. So Viper, if you wanted to buy a particular stock of, say, DocuSign at $68, I could sell you shares of DocuSign for $68, even though I didn't have them, because I borrow them from my broker. I sell them to you. You pay me the $6,800, so I collect that from you, but I owe my broker 100 shares of DocuSign. So what I will hope to do is I hope that DocuSign will drop from $68, let's say, to $58. I will then go to the market to buy 100 shares of DocuSign for $5,800. I will then give them to my broker and say, hey, thanks, buddy. Thanks for the loan. Here's your 100 shares back. Now, I bought those for $58. I sold them to you for $68. I made $100 or $1,000 on that trade because I collected $6,800, but I paid $5,800 to close it out. And that's what a short is. And so the worst case scenario here is I'm short 100 shares of DocuSign at $68.71. Now the risk here is after I sell you those shares, if DocuSign goes up and up and up and up and up, my broker can come to me and say, hey, buddy, I want my 100 shares back. And if DocuSign is trading at, say, $78, I have to go out to the open market, buy those shares at $7,800, and I just lost $1,000. And that's kind of how a short works. And so it's a little bit different thinking, but that's effectively the risk that I'm taking, is to be short those shares at that strike.
And I go back and forth on how I like to think about like in the early stages of like learning about shorting and what it meant mechanically and whatnot. And I go back and forth on, obviously the easiest thing to say is it's the opposite of buying, but your risk is potentially greater than buying. And so that's a key difference, kind of like you just said. When you buy, your risk is still great in that you can lose 100% of the money that you bought with, but you're accepting that risk by putting that money on the table. When you short, this thing goes up forever, and you just continue to have to buy it to pay that back. So it's not likely to get into mortgage the house to cover this debt. Your brokerage knows exactly how much money you have, and they have their own tolerance level of how far out on the branch they're willing to let you go. And that's kind of what Sprocket mentioned, where they will come knocking if they don't see the money in your account, and they say, hey, this is too tight. We got to wrap this up. We need those shares back.
Yeah. So they'll take a look out for you. And like I said, I am not a big fan of shorting shares just because the risk side to the upside is very, very high. It's okay with the right controls and things like that. It's not something I like to do. So I do get nervous on any situation where we can have a naked call like in this Strangle. However, Viper, I did have you kind of pull up the chart, and I think you've done a great job in kind of highlighting the potential price movement for this one-day event. And in the event of a very large move from earnings, what might happen from the downside if I was assigned the shares, or what might happen from the upside if I had to short the shares and buy them from somebody.
Yeah. So I think it's interesting because as I continue to think about this, because we dug through a lot of the thinking before recording, but then as I continue to think about it, this is a particularly unique situation where the Strangle potentially makes sense. And so we can take a look at the chart here and kind of see what I mean by that. So obviously on the chart zoomed way out for the history of the chart, we do see we have this massive gap here. This thing is volatility is in its DNA. And there's all kinds of reasons for that. But nonetheless, this is where some of the thinking has to start when we start to analyze, is this Strangle a good idea? And even more so than good idea, just where are the probabilities of this? And the reason I say I think we're in a very unique situation down here is because just where we are in the move. I think that's an important consideration. If you are ever, toying around near all-time highs, you don't really want to be in too many plays that require more upside, which is to say around all-time highs. I'm not saying you go short all-time highs, but around all-time highs are where you're potentially looking at for the technical analysis to say we need to retrace, we need to go back and retest something. Likewise, when you're near the bottom, you're starting to think mentally about looking for plays that potentially, you want to go to the upside, and there's limited downside just for the way that's working out. So when it comes to this Strangle, what I think is interesting is, looking at previous earnings. If we look back here in June, there were earnings, and there was a massive gap up to the upside. So, we were in a downtrend here. We got earnings, and then we went and actually made new all-time highs. And so my point here is this is not a scenario, even before this happened, this is not a scenario where you would think a Strangle would be a good idea. And the reason for that is going into these earnings, we were sitting right here in price. So where is that in the technical analysis? Well, we're coming off of an all-time high, but we are very, very far away from the low that launched us into this all-time high. So we're not really looking to get into a Strangle here, because there is the potential to break way down if this downtrend were to continue. and there is the potential to go get a good test here and then go break a new all-time high. And these are just two big movements in opposite directions that are exactly what we do not want in a strangle like Sprocket laid out there. So bringing this in a little bit closer now, if we auto magically drop down some levels on here that I drew out. I didn't draw up on the upper chart because we're just really not worried about, focus on your range and what range your play is in, and get a good chart there. So what we're looking at is a couple key areas here. So red indicates a monthly level and blue indicates a weekly level. Talked about this on previous episodes of charting. You can give the perceived strength to those, monthlies being strong, weeklies being still strong, but maybe a little less than the monthlies. And so where are we right now? We're at 55.14 as of recording. And we're looking at, the swing, the bottom of the swing that launched into this all-time high. Both of them really, but I mean, there was a little retrace here, is coming off of this area over here. Let's go ahead and throw down a couple of these levels. Well, over here is where we actually started the move that took us up to all-time high. I like to draw a little range there because you do not, need or want or should expect to catch these knives. You want to have a range identified. And so I've identified and drawn out this range. And so we'll color that in because we don't know exactly where the price is going to go. But the TA says that if you lose and fail to make a new all-time high, which we clearly did, then the trend is down to go retest the bottom of the swing that launched that all-time high. And you can look at the chart yourself. There was already a level that, we saw that little hiccup in the chart where we got the second all-time high. We already tested that, blew through it, and kept coming down. And so this blue range, I think, is a very important level here that I think we're going to, potentially find some strong support. That doesn't mean we won't lose it, but it is the level that TA says we're going to go test. And so risk-wise on this play, we just heard 45 on the low side, or 48 on the downside with a 45 cost basis, is where those long shares get had. And 68 and some change is where the short shares get had. And so now we really get into where I think there's a lot of this unique opportunity, because look at where we are right now in regards to these two levels. I mean, we're smack dab in the middle of that, which makes this strangle all the more interesting. And further building the case for the unique nature of where we're sitting, it's not just being in between two levels. You can do that up and down the chart and really have a bad time with a strangle. What I think is interesting here is the two levels we're between are very significant and major. So obviously on the downside, the level is the bottom that TA says we are going to go test. And test being the key word doesn't mean we're going to maintain support, but it will be a big test. And on the upside, this 67.13, I've actually drawn it as a thicker level because I think the TA supports that this is a significant level for a couple reasons I want to run through real quick. One is this was an all-time high previously. So again, giving strength to levels when they present themselves as former all-time highs, those are levels you want to have support that major action happens on. And if we take a slightly closer look at this level, we see some interesting amounts of action that happen here. So on this run up, we set a new all-time high, and we did get a minor retrace reversal where we came down all the way from $91 and we came all the way back down right to that 68 former all-time high level before finding support, which then continued the uptrend, continued to go find a new all-time high. Likewise, what I thought was interesting on the downside, coming down off of the all-time high, We had an earnings gap here, and this is a significant earnings gap. As you can see, we gapped down. We didn't quite get all the way back to this 67.13 as I've drawn it, but it got down close enough that elasticity that we've talked about, that we were stretched, but we also found support around this level, enough support that we went from $70 all the way back up to $112 on that bounce, while still maintaining the downtrend. So that's another, I'm going to drive that point home, because you're in a downtrend, and I'm sure me in another version of myself would have bought this top. I mean, you see it hit $70. You see it springboard back up to $100, $110. You haven't played through the different technical analysis theories and price action, and you think it's good. It hit the bottom, but there's all kinds of reasons. I mean, we're still in the downtrend, and so I'm just calling that out to put that importance out there of always watch, get the macro trend in your mind. And so now we come off of this 112, and sure enough, we're continuing the downtrend, and we go all the way back to that 67, and guess what? Yet another significant bounce off of it, but this time back up to $90. And then finally, we had another earnings gap, and this is a massive gap, and we gapped right through that level, and then we finally broke it, but we still kind of went sideways a little bit here. So all that is to say that I think this 67 is a very important level, which now that we're on the bottom side of it means it potentially poses a significant level to break through to continue a trend up. So it will potentially have some significant resistance there if we get a big bounce here. So pulling it together to what all this means, we're sitting at this 55.14 currently. So what could happen in a major gap moment of earnings? Well, we're still in the downtrend, and we haven't tested the level that TA says we need to test, which is that 43 to 45 range down here. So TA tells us the majority probability, the most probable thing to happen is we will still continue to go down there. And again, nothing is certain, but we play the game of probabilities. Probability says we will continue to close this gap and get down here. Now that doesn't mean that the gap in earnings couldn't get down there and rocket back off of it. Everything we've talked about before of accelerating trends. And that's kind of the couple scenarios we played through here of, okay, so accelerating trends. So we gap down, we hit this, then what? Well, unknown, but based on how the level 67 reacted, I believe that the most probable case is that there is support, significant support here for a number of reasons, that we will get a bounce off of here. And now, so we're bouncing, so that's good for the play, for the strangle. But what if we bounce too high and we go above that 68? Well, then we get into this constraint of 67.13 being such a significant level that I don't believe there's too much risk of breaking through it. So one thing I think this could look like is if we just bring in that trend of that previous drop, we could get this gap here and do, maybe something like this where we actually gap down, we hit this level, we bounce off of it. Trend is still down until proven otherwise. And so we will not reverse this trend until we can regain 67. So the most probable thing is a bounce. There is plenty of, there's several levels here to test between that we could bounce and reject off of, but I think the most probable worst case scenario is going all the way back up to this 67, reject off of it, and then continue the trend down, or at least give the bottom another test here. But everything's unknown, and obviously we're playing those probabilities. But to the risk on the upside, though, I think this is what also makes this interesting, is being short those shares at 68. Everything I just laid out suggests that's not the worst place to put a short on. So if it does get up there in this 1 day move of down and bounce, and then it gets, you get assigned the short the shares, the TA still suggests that there could be strong resistance there, and then you're short those shares, and if it drops to $66, $64, you don't have to wait for a mega move, close it for a little profit, and now you're up the premium, and you're up that $2 move on being short those shares. So I think the chart shows that this is a very interesting play.
The other graphic I'll toss up here to look at is the P&L chart of this particular trade. And the reason is this kind of highlights it in a different form that Viper just showed. So Viper showed kind of with the time. Here your price goes left to right. And this blue line is my profit and loss at expiration. The purple line is the profit and loss now. And so these hash marks over here to the left and to the right, I put these where my break even is. And the center one is currently where price is at. And so what you can see here is that as price drops towards this hash, I can keep money here. And if we get that, down here and bounce back, as long as I come in between this range, I'm going to go ahead and collect all that premium. And it's interesting because normally we say, oh, you only collect a little bit each day. If I just kind of advance this just 1 day, watch how much this purple line moves. Because this is how much theta is going to come off this in just 1 day. Like it just jumps massively. And this doesn't even include volatility contraction. And so the very nature of this play is very, very fast. And the percentages here of the likelihood of moving into these ranges, I know one of them's behind our picture, but that's 0.25% and about 0.7% chance to be below this hash and above this hash. So about a 1% chance currently that the 1 day's move will move that far based on the current volatility of the stock. Now, it's an earnings event. It's binary. Anything can happen. But this is all about that probability and where is it going to put us. And from my perspective, this is really tilting a lot of things in my favor. And like we say with every trade we enter, know what your profit targets are, know what your exit points are, up, down, whether the trade goes your way or not. So it's very easy. 1 day trade, we stay between the range. Perfect. I make my profit, 100% my profit. Wonderful. Well, what's the negative? That's what Viper just went through. The negative is you end up long at, the 43 and change price point, or you end up short at 68 and change price point. Either way, we went through that example, and based on the technical analysis, those are not terrible positions to be in. And that's all the possible outcomes of this trade. You stay in the middle and you're happy. You get assigned at 43 and you're not sad, or you get short at 68 and change and you're not sad. It's not the best, but that's where I'm talking about. Know all your exits, know all your moves before you enter this trade.
Yeah, absolutely. And I mean, just at risk of beating the dead horse, being long those shares that low, like we saw in the chart, if you made a strangle when the price was up there at 170, 150, 160, something like that, and you were long shares on the downside at like 140 or something like that, you were so far away from this natural, I don't want to call it a bottom because, bottom is zero, as some people accurately state it. But you're so far away from the critical technical analysis level that you have a significant loss that you can take on being long those shares at that point. So, like Sprocket said, being long at 43, not the worst position to be in, even if we weren't in options. There's clearly going to be a lot of people buying at that level based on the TA alone, which, is worth considering.
Welcome to the future. The DOCU earnings have been played out. The trade is over. I am out of it. we are going to take a look at how this played out for us. So let's bring up the chart, and I'm going to take you through the DocuSign earnings. I ended up entering this trade around a little bit after 10 o'clock, I believe, in the morning of earnings. So earnings were going to come out after the bell. I've started this chart approximately when I entered the earnings. I ended up bringing the strikes in just a hair to 47 and 67. I've updated the chart. We've got our markers here. Green is full profit. The borders there in yellow that's where you start to exceed the strikes and kind of start going down a decline. And outside of there is where I'm losing. And remember, what I was playing for here was a volatility crush. So as soon as the earnings are out, all the uncertainty is gone. These options expire that day. Volatility should have gotten cut by greater than in half. And indeed, that is what happened. As I entered a little bit after 10 o'clock, as the units ticked by, the stock actually stayed pretty, in the middle throughout the day. I entered in the earlier part of the day because theta is going to start declining throughout the day. Now, volatility won't have crushed much. And I was really kind of hoping for treading water throughout the trading days. So I entered early. A lot of times in the earnings plays, I'll try to enter just before close so I can kind of center up my strikes going into the Strangle into the after hours. But this one I actually put on a little bit after 10 o'clock. And we're kind of approaching here, and we go through here, and we're getting close to the after hours earnings. And when the earnings came out, you will see a massive jump up, just a huge green candle. So the earnings were very positive. They had great forecasts. They beat their earnings, and you'll see, boom, right there was when the earnings announcement came out. And you can see we actually breached my strike when the earnings came out. And we didn't exceed it into the realm of starting to lose money. And in after hours, you cannot trade options. So once you're out there, you're kind of just watching it, and you're at the mercy of what's happening after hours trading. We got a morning after hours session, and I was feeling pretty good about this. A little bit nervous because this is on the upside. We got a little bit more of a pump right up into just right at my break even. And remember, the worst case scenario to the upside was that I was going to end up being short on the following day at expiration. So somebody exercised early and they ended up putting those shares or calling those shares away from me. I'd have to buy those shares or sell those shares, at that $67 strike. So I collect $6,700, but I would be out those shares if he borrowed them from the broker. And my plan would be to try to see if the stock would fall from there, which was a very probable outcome because this was a huge stretch up from where it had been trading. The overall trend in DocuSign was down, and I was accepting that short 100 shares should that be the outcome. And sure enough, shortly after the earnings came out, you'll see a couple of the ticks started to losing steam and didn't get right through that break-even part. And then the after hours the following day started coming in, and we opened up, and this was actually before open, and they really started losing steam in the pre-market. So this is good for me because, I want to back off that strike. I'd love to see this thing come back down in between these markers here. Because remember, I'm looking for volatility crush, and I was expecting about at least a volatility cut in half. So when I sold, the volatility of that option strike was about 250% volatility. And you can see as the market came down, we're still in pre-market, and right there, that massive red candle was market open. Just beautiful trace back there. And the volatility on open was roughly 80%. So we had more than a 50% cut in volatility. We went from 250% volatility down to 80% volatility. And with any one of these options premium selling, I love to close them out at 50% of my max profit. So remember, I sold this thing for, I think it was around $2.08. So as soon as I can buy these things back for about $1.04, I'm going to do that, close it out. My risk is done. I've made my money, and I'm going to look for the next volatility crush play. Now, I actually let this sit for just a bit, and I grabbed a couple of these red candles, and then I said, okay, I'm backing out. And so I closed this trade out probably about 30 minutes into the trading session, and I was able to buy that Strangle back for 46 cents. And you can see as the trading day went on, we didn't really give back more. And as we kind of got into close, if I'd have hung on to those, we'd have pushed back up, and we didn't quite close back up at the strike. So this would have ridden out if I did not close them early to that 100% profit range for me. But like I said, I usually don't leave that much risk on the table. This thing could have gone through the strikes. I had about a 70 or 80% return on profit available to me. I closed them out for 46 cents, put $1.62 in my pocket. And I was happy. That was less than 24 hours. I put that trade on the day before, took the trade off on open the next day, boom, overnight. And let's take a look at what that actually was, just to recap that for you. So here are the statistics and the numbers that I had on this trade. Remember, my thesis on this trade was DOCUSign is going to move, but it's not going to move crazy. Not crazy up, not crazy down. And so I took a 16 delta strangle on this. And that ended up changing a little bit from earlier in this episode where I said, oh, look, we were looking at I think it was the 48 put and 68 call. That shifted in a bit to a 47 put and a 67 call. Collected $2.08. That's $208 in premium on the sale. On open, I was able to buy it back for 46 cents because that volatility just absolutely crushed. Went from 250% to 80% volatility, tons of premium deflated. I was able to buy that strangle back, close it out for 46 cents or $46, which means I put $162 in my pocket, and I had risked on my buying power, the return on capital. The capital I had to put up was about $860. So that is a 19% return on capital overnight. Now, pretty good. I was very happy with this. This is textbook volatility crush. They do not all play out this way. I have done many earnings trades over the years, and they actually end up coming pretty close to a 50-50 split when it comes to win and lose. So I've plotted out statistically when I do my 20 delta, 25 delta plays, those tend to go to that ratio of winning where I'm winning, 75, 80% of the time. When you put on earnings trades, a lot of times the probability will look a lot different going in, but a lot of earnings trades are 50-50s. So if I look over all my earnings trades, a lot of times they end up being 50-50, but they're a ton of fun. It's like you put the trade on, what's going to happen the next day, and you're out. Sometimes you're out with a little bit heavier of a wallet. Sometimes you're out in the worst case scenarios. And that's why we prepare for both of those scenarios, whether or not, in my case of this strangle, my worst case scenario was I was going to be long 100 shares of DocuSign, or I was going to be short 100 shares. In both instances, I was okay with that probable outcome should it come to be. Of course, the probability was in my favor that we were going to get volatility crush. We're going to stay within the expected move, and we were going to walk away a winner, which is what happened in DocuSign's case. So that's how it played out. So this is just another dimension to option selling. This adds what I like to consider, or what I like to call kind of an added excitement, because, a lot of the option trades that I put on are what I call long and boring. It's, step, left foot, right foot, just this boring burning of theta, contraction of volatility. Earnings plays are super exciting because they are huge volatility crushes within one day. Earnings come out, all the uncertainty's gone, price goes boom, and it'll really expedite the trend. And so it's pretty funny. Or it's pretty fun to have that kind of instant gratification, or I guess instant disappointment, which is why we talk through all scenarios, because when I put this trade on tomorrow, by the time the weekend comes around, I'll know, where I stand on the trade, whether or not it was a winner or if I'm going to be short or long shares going into next week. So hope you guys enjoy this episode. Reach out to us in Discord. Let us know what type of content you want to see. Good luck out there with your trades. The market is kind of getting exciting lately these days. So good luck in what you're trading. Have fun. And remember, think outside the block.